So if you're dealing with a reverse mortgage foreclosure, you don't know what to do, you don't know where to turn, and you don't have the money to pay an attorney, get the scoop and the solutions on how to fix your issue today. Stay tuned. What's up, everybody? Welcome to Ask Rinde. I'm Rinde Adebayo, digital entrepreneur, real estate entrepreneur, and top producing agent here in New Jersey, and welcome to Ask Rinde. If it's your first time at the channel, please hit the subscribe button and smash the like button. I do videos about foreclosure, income, and credit, and I'd love to have you as a part of our growing network all around the country. So what is a reverse mortgage? So in essence, a reverse mortgage is a loan. It's a specialty mortgage product that's offered to people who are 62 years and older that basically have equity in a property and looking for a better monthly living situation. It's more a lifestyle product, and it's targeted at the emotions and pretty much looking to try to solve their issues that they're dealing with monthly. As we know, more and more people are retiring with less savings, and the cost of living overall in the US has gone up. So currently, seniors hold $6.5 trillion in equity nationwide. That's a lot of money. And that's a lot of targeting for these reverse mortgage companies. So the key issue that the reverse mortgage is supposed to solve is supposed to be making your monthly and your lifestyle more comfortable. It's supposed to basically put you in a position where you're not doing so much monthly. That monthly you can just basically deal with your basics, such as your food, your gas, just your basic needs, and not have to actually come up with money on a fixed income to be able to lay out and shell out for an exact mortgage. Now, a reverse mortgage can be good for some and bad for others. It all depends on how you deal with it and what you do with the reverse mortgage and the proceeds that you get from it. So in this video, I'm going to touch on the pros and the cons, and I'm going to give you my take as someone who's dealt with reverse mortgages firsthand and seen the effects of it. So reverse mortgages are also called HECM loans, or HECM, home equity conversion mortgages. And the key for this is that they're targeting seniors who are 62 plus that basically have low savings and also fixed income. So I call this the carrot mortgage. And the reason why I call it the carrot mortgage is because they come dangling the carrot. The carrot would be, okay, so you're 62 years plus, you have fixed income, you have pretty much no savings. We know that every month to month, things are hard because you're constantly paying a mortgage, you're constantly having to come up with money, and it's a strain, and you don't have a job, little to no savings, or some savings, but not enough for them to have a comfortable lifestyle. So the reverse mortgage companies, their appeal to them is the fact that they can leverage the home equity in their property, extract that money out, not have a mortgage payment, and just deal with the basic expenses that they have. And it's very, very good because they don't have to basically make that payment every month. They're dangling the carrot. Now beware of this carrot, because reverse mortgages come with its pros and its cons. You really need to know what you're getting into when you're going for a reverse mortgage. Do not just take whatever someone's telling you on face value without digging deep and really considering the consequences.
Friends were my parents. We were very close.
And now, 6 years later, she's reliving that pain because of a reverse mortgage her parents had on their Largo home. The mortgage, the kind that pays an elderly homeowner a monthly payment until they die, was supposed to make things easier on their children. Her father told her the house she grew up in would just go back to the bank.
Everything's taken care of. You kids won't have to deal with anything.
But for some reason, Bank of America failed to take back the home and let it sit empty while the value slowly dropped. And now there's a foreclosure with Prue's name all over it.
The requirements are you have to be 62 years plus, and you also have to go through a HUD counseling session that's going to be about $125. You also have to have the property as your primary residence. It cannot be a secondary residence, it has to be your primary residence. The two things that trigger a default on a reverse mortgage would be if you are not staying in the property, is not your primary residence, and it's proven that it's not, and also death if you pass on. Generally, you need to have 50% equity in your property in order to start the process of qualifying for a reverse mortgage. Also, the older you are, the more money you can extract. It's what we call the IPFL, initial principal limit. The initial principal limit is the cap that they put on of how much you can pull out of the property and out of the equity. And generally that's capped off at about 58%. The older you are, the more you qualify for. The younger you are, the less you qualify for. So let's talk about the pros and the cons of the reverse mortgage. First, the cons. Your heirs inherit liens, meaning that your heirs are going to be inheriting debt as opposed to inheriting actual equity and money from you. Number two, closing costs. So you have to be careful with this. You want to make sure that you're not being overcharged for your closing costs. Number three, the balance grows over time. So as we know, the banks don't do anything for free. So in essence, the way a reverse mortgage works is that what you're doing is that you're borrowing against the equity in your home. So let's say, for example, your property is a $600,000 property. It's valued at $600,000, and you decide to get a reverse mortgage. The property is owned free and clear. What you're doing is borrowing equity against that $600,000. You're extracting and making liquid the equity that is in your home, and then using that to be able to live and basically have a comfortable lifestyle without having a monthly mortgage payment. The way the banks make money is that they charge you interest on that money that you extract. So there's several methods that you can use to extract the equity out of your home using the reverse mortgage. The first one will be taking a lump sum payment. The lump sum payment is the only method that allows you to have a fixed interest rate. It's the only one because you're taking out the entire amount and putting it into the bank. So you have a $600,000 house, you take out $300,000, that $300,000 goes into the bank. Now, where the bank makes money in doing this is that they actually then will charge you interest on that $300,000. So as opposed to you leaving the $300,000 in your property, sitting there without actually being charged for that money, you're in essence doing a reverse mortgage, extracting the money out, and via a lump sum, taking the $300,000, putting it into an account, basically, that the bank will then be charging interest on monthly. So what happens in essence is that your loan balance goes up monthly because the interest charged to you accrues onto the loan, tax onto the loan, so your balance goes up. So in essence, what happens is that you're sucking your equity out little by little. Every month you lose less equity in your property because of the interest that's charged on the money that you took out via a lump sum. The number four con would be high interest rates. Wow. So this one here, I've seen interest rates as high as 13, 15%. When it comes to reverse mortgages with clients that I've had here operating here in New Jersey. And the interest rates are also adjustable. The only method of a reverse mortgage that has a fixed interest rate would be the lump sum. The others, such as a credit line or a monthly payment payout, such as an annuity, they all come with adjustable. Number five, the bank is banking on time. The older you are, the higher likeliness you are to pass away. Unfortunately, the bank actually assesses this. They assess your health when they actually review your file to see how far along you are and basically see if they can have an opportunity there to not only enter into the reverse mortgage with you, but to make money. It's a real sad fact, but this is a big part of it because as we all know, one of the outs of the reverse mortgage is death. And so the older you are, the higher likelihood is they see you coming to the end of your life. So it's an attractive tool for them to be able to get in and get a part of your equity while you're still alive. Number six would be the fallacy that it's free money. You know, you've seen the commercials where they have and hire these celebrity endorsers to be able to endorse a reverse mortgage. They call the hotline and basically start the process, and it's so easy, and they paint this picture that it's so rosy and it's so beautiful and it's such a great life. It's carefree, it's free money, there's no strings attached, and it's all a complete lie. Because as we all know, banks don't do anything for nothing. They make their money off interest. They're banking on several factors by giving you this money. And we're going to cover a little bit more, but please understand that it is not free money. Number seven, you pay your taxes and your insurance. I cannot tell you how many clients that I've had lose their property with a reverse mortgage, how many reverse mortgage foreclosures I've had to get involved in to help them because of tax delinquencies. One thing that is with a normal mortgage that's different than a reverse mortgage, the reverse mortgage, first of all, has to take first position. So if you have an existing mortgage on the property, when they approach, they're going to make sure that that loan gets paid off and absorbed because they need to be in first position. That being said, this is not like a normal mortgage. They're not going to include the monthly, the taxes in the monthly payment along with the insurance. Those things are your responsibility. And if these are people who are seniors, you know, I don't know if you all have had situations with family where, maybe you have a mom or dad that's fell ill and you've had to take care of them. It's a lot. Anyone going through that knows that it is a lot because you're handling your own situation. Here you are, you have your parent who's taking care of you and raised you. Now they're going through this part of life and they need help. They need help with balancing bills, budgeting. They need help with getting around grocery stores. They need help looking over their health situation. So with all those things going on, imagine being a senior and looking and doing that yourself. It's almost, I don't want to say virtually impossible, but it's very difficult because this is someone who is in their mid to late 60s and above, and they're dealing with so much from a health perspective. They're retired, they're supposed to be enjoying their life at this point in time, but they're still dealing with having to pay bills, having expenses, et cetera, et cetera. And so keeping track of, when the taxes are due quarterly, et cetera, and insurance, those things can sometimes go missing. And what happens is that there is opportunity, ample opportunity for people who purchase tax liens to buy a tax lien certificate against the property. So that is a big con because what happens is that this is not an automatic payment. They have to be cognizant and make sure that they're on top of paying their taxes and their insurance. The next con would be if you take more than what's needed. A lot of times people get drawn in by the loan officer, whoever's closing the loan on these reverse mortgages, enticing them to take more money than what is needed. They'll say things like, wow, you have $500,000 in equity. Why are you just taking out $70,000? Why are you just taking out $60,000 to pay those credit cards? Why don't you go for it? Just go ahead and take out $150,000. Take $200,000 out. The problem with that is the fact that the more money you take out, the more money they make basically on their fees. And so the higher the amount, the more money they make. So it entices them for them to tell you that in order to be able to make more money. Issue with that is the fact that you're taking out more money against your equity, which means basically that the interest rate, you're drawing out more money against your equity in the property because they're charging an interest rate on a higher amount. It's just dicey. It's a big problem if you take out more money than what you need, and that's a major con. The next con would be removing your spouse from the title. So this is one that is tricky because what happens is sometimes people go in and they start this process and they're both their name, the husband and the wife, are on the title. And so the reverse mortgage generally is based off the younger spouse. They will actually look at the younger spouse to basically base everything off them. And what you want to make sure is that the other spouse is not removed, because by them removing that spouse, should anything happen to the older spouse, let's say, for example, unfortunately, they move on or pass on, or let's say they have to move into an old folks home for a while. And as we know, those things can be long-term because there's no telling their situation. There may be a situation where they're at such age that the other one can't take care of the other one. And so that person needs help. They need care 24 hours. So they don't have the money to bring in an aide. So they have to send the older spouse over to an old folks home or senior facility to have that round-the-clock care. And what happens in essence is that if it's only that person on the title, then the issue becomes, if anything should happen, there are two issues that you can face. The bank then can say, well, we have proof that you're not using this as a primary residence because you moved to an old folks home, right? Especially if it's over a year. Second thing could be also, if the person passes on, the other one may not have a right to basically stay in the property. This is when you see people get foreclosed on, and the other spouse who's been there the whole time, because they were moved on title during the transition, they are stuck and they're in a situation where they're sitting duck. They're pushed out of the property, and the bank takes the property and sells it, and it keeps all the equity. So the positive side of the reverse mortgage, like I said, this is good for some people and it's bad for others. The good thing about it is obviously you never have to pay a mortgage. So instead of you paying a monthly mortgage every month, in essence, you don't have to do that. The second good thing about a reverse mortgage would be the cash flow. Now, I say this cautiously because it seems enticing to be able to get cash flow from the property, and it seems like, wow, I got money and all that. And it all depends on what you do with that money. It's all about stewardship. It's how it's handled that makes the difference, whether or not it was a good decision or a bad decision. So cash flow is a positive because you have money, you're liquid, but then it depends on what you do with it. The third good thing about the reverse mortgage would be the options that you have. You can either take it out as a credit line, or you can take it out as a monthly payment or an annuity. So in essence, they'll pay you monthly an amount, fixed amount, or you can leave it there as a credit line and draw on it as you need it. The next good thing about a reverse mortgage is that you have up to 1 year after you pass to make a payment, to have to start making payments. Many of us know that traditional mortgage, you have to make the payment no matter what happens. We know that from being and dealing with probate situations nationwide. So, but with the situation with a reverse mortgage, you have up until after a year after you pass to have to be obligated to start making payments, or your heirs have to start to making payments. The next good thing about the reverse mortgage is that the FHA mortgage covers and insures it over any negative value. So in essence, if the property falls into a short sale, you're not responsible for that difference, basically, because FHA insures it and basically secures the bank, and that's why they even like this instrument or this product, because they know that they're insured. So in your case, you're not responsible if the property is worth less than what the value is. The next good thing about a reverse mortgage is that the proceeds are not taxable. So when you actually take that $200,000 out, or $150,000, or whatever it is, whatever amount that you take out is not taxable. The IRS pretty much consider that like a loan advance. The next good thing about a reverse mortgage would be that it requires no income and no credit. Now, of course, that could go either way. But the thing about it is that you don't have to have income and credit. It's not something that's based on your monthly income for you to be able to qualify for. The things that qualify you are going to be more having to do with your age and also the equity position that you have in your home and the appraised value of the home when they send their appraiser out to assess the value. Now, there are two things that I want to talk to you about regarding a reverse mortgage that are very important. The first thing is that reverse mortgage is supposed to be a non-recourse loan. Now, if you know about non-recourse loan and non-recourse debt, it's pretty much debt or a mortgage that's collateralized by real property, but that the owner is not personally liable for. Now, I can tell you this emphatically from dealing with these situations one-on-one and having clients that I've dealt with and moved through this process, that the banks figure out and finagle ways to be able to deal with or personally make liable the homeowners. So there are some things that they've done in the past that have basically contrasted the idea of the fact that the reverse mortgage is supposed to be a non-recourse loan. And I just wanted to caution you on that, to understand that you need to basically be careful with whichever mortgage company you're dealing with, who your lender is, because although it's supposed to be the case that it's a non-recourse loan, what our experience has been is the fact that all the motions and what they've done in order to be able to receive possession of the property, etc., in addition to some of the other tricks and things that they've done to basically recover the property, have basically been actions that have been contrast to what a non-recourse lender is supposed to take the position of. The other trick that you need to be careful with is that watch your mail. You have to be very careful because the bank has a right, once they've established the idea, the fact that you are not living in the property as a primary resident, then they have the tools and the ammo that they need. So when it's time to go to court before a judge, they can actually show and say, hey, we sent this letter this time, we sent this, and we have proof that they no longer live in the residence. The reason how I found out about this is because I actually had clients right here in New Jersey that actually had to bail out. These were a couple, they were both 75 years old, and same name, ironically, and basically, childhood sweethearts. They lived together, they never had children, and when I came on the scene, they had a reverse mortgage with Wells Fargo. And what they told me, what we uncovered by me working with them over the course of a year and a half, trying to help them, was that Wells Fargo, what they were doing was actually sending mail to the property and trying to establish a case that these people didn't live there. And when we would call, because I had third-party authorization, they would say that, well, we sent this and we basically sent this correspondence, and we're seeing that we're not getting a response. We're seeing that we're not getting a signature when we actually send it to signed receipt to a sender. We're not getting any indication that you live in the property as a primary resident. We've established that fact. Now, of course, I'm calling the bank. I'm sitting in their living room. He has a defibrillator machine hooked up to him because he's going through remediation. He had cancer. She's there. She just had an accident. She had her foot hit when the car rammed her door. These are people that are 75. They have nobody, have no children. They have nobody helping them. And I'm on the phone with the bank and I'm saying, so you're telling me that these people don't live in this property primarily as a resident? That's not their primary residence. The bank said, yeah. And I looked at them and I looked at the phone. That's what the banks do. They will establish a case to try to say that you don't live in the property. You have to be very careful with that. So if you're facing a reverse mortgage situation, your backup is against the wall, you don't have the money to pay an attorney, you don't know what to do, you're getting letters in the mail, you're scared, you don't have family to help you, please reach out to us. My email is below, askrindenow@gmail.com. Also click the link below because in there we have a form, one document that we use to be able to send to the reverse mortgage company to stop them right in their tracks. So if you're a senior, you're retired, you're on a fixed income, you're struggling to basically figure this out, you thought you did the right thing by getting a reverse mortgage, and now you found yourself in a position where you're facing foreclosure, you have a tax lien, you have issues where the insurance is not paid, and you're not really getting any way out, please reach out to us. We would love to help. We need to talk to you and find out from you when and where you are in the current process. How much is the debt on the property? What correspondence have you received from them, and exactly where you are in the situation. We would love to help. That's what we're here for. And I just want to say one thing. Most of my videos that I do, I'm not here to be able to get on camera and show you how much I know and how versed I am in a specific topic regarding foreclosure. This is my expertise, my background. What I'm trying to do, what I'm establishing here is a network to help, genuinely help, because I'm dealing with people who are going through 1, 2, 3 loan modifications. They're dealing with a situation where there's a constant cycle. They're not coming out. So we want to be able to set up something to give you that will basically genuinely help you turn the situation around and grow our network. We want a sustained network that basically people from all walks of life, retired, people who are still working, people who are wealthy, who are poor, they can all come together to be able to help each other and grow. So that's the goal of the Ask Rinde Network. Definitely click the link below to be able to join our network. And I look forward to talking to you. Please reach out to me so I can help you with your reverse mortgage foreclosure. And until next time, thank you for watching.